Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 3rd, 2012 edition of Market Outlook. So if you like the text that you read and you like this video, please go to the website MarketGauge.com and sign up to make sure you get it for free every week. Or if you just want to see this video, you can go to our YouTube channel, MarketGauge.com. All right, so we had a pretty nasty week. More importantly, a lot of economic numbers came out globally that showed a slowing global economy. Markets got pummeled. Let's see where we are. And this week we're going to focus on longer-term charts, certainly the weekly charts, to give us a picture of where some support levels might be and what is really going on and the interrelationship between the stocks, gold, bonds, and the currencies. So, first chart, we can see, number one, the Dow breached with a gap down, sort of a breakaway gap from this sideways action that we had discussed, that we'd get a pretty good size move. We got a fake out. We got a fake out and a breakout to the upside early in the week, then reversed, and with the bad economic news, closing under the 200-day moving average with good volume. But let's take a look at where we are on the weekly charts, and you can also see that we have breached the 65-week moving average, which is this blue line right here. So the next level of support longer term is the 200-week, which is, another 15% or 15 points away. Now, we also have a critical trend line. Let's put in this trend line and see where we are here. And that's another important area of support. So you can see if continued pressure, we would expect maybe a slight penetration, but some pretty decent support either to materialize right around this level here or at around the 115 level, where this trend line, this longer term trend line from the lows in 2009 should really hold. If this gets breached, that's pretty ominous. You can have a pretty sharp and very vicious decline. It wouldn't be pretty, obviously, getting down another 5 or 6%, but that would not be the end of the world, and quite honestly, it would be a 15% correction, still not quite bear market territory. Now let's take a look at the spiders, because they're telling another story. On the weekly chart, you can see that we have breached the 200-week moving average. I believe it's the 200-week. No, that is the 65-week. Let me change this here. We'd like to look at the 65-week and the 200-week moving average for sort of an intermediate term reading. Okay, so in this case, we have already breached the 65-week moving average. Next logical support from a long-term trend perspective is around the 114 level in the S&P. But again, both of these key averages have reached support. Going to the monthly chart, you can see on a long-term from the very lows, this is a pretty good, it's about a 45-degree angle. We breached that. That's going to be pretty serious. Now, what's interesting is that the 80-month moving average comes in around 124, so that's a likely level of support as well. And of course, this long-term trend line, this is a really important trend line, right? Because you have a low here, all right? A high, well, it's actually a low, a high, a low, a high. So this is certainly a valid trend line. We breached that. We're in for some serious sledding here, and this is definitely a very, very important level of support. I look at this 115 level to that also the 123 to 124. Those are two critical intermediate support points on the monthly chart, and we break down this long-term trend line, that is really something critical to watch. So right now, market's under pressure, starting to breach some important moving averages, but we do have some support underneath the market here. And the key factor is, what are the central governments, central banks going to do to keep the markets up? Certainly they're going to try to keep things going. So the question is, how and when will they try to step in? Let's take a look at the Qs. Now the Qs are our strongest index. Of course, it carries Apple, Amazon, a lot of the leading stocks in the market, the leading tech stocks. And that's a completely different picture than the breaching of support levels and critical moving averages, because NASDAQ, or the NASDAQ 100, is trading above this consolidation and this compression that lasted almost a year. So this whole area in here is a critical level of support. You can see I put in this trend line which coincides with this week here and these highs here. So I'm looking at this 59 level with additional support of this long-term uptrend line here, still keeping the NASDAQ well within important support levels. So 59 level on the moving average, a little bit higher on the absolute support, and all of these coming in around this pretty critical level. So overall, if you're going to look at the strongest one, if this can't hold this particular area in here, we're in much deeper trouble than anyone probably had thought, even at the beginning of this move here. So these are the critical levels. Obviously, watching the leading index, seeing how it performs near critical support, is going to be your lead indicator. You got some other indications from the SPYs and the DIA, but hey, listen, if the leaders are getting shot, that's going to put a lot more pressure on the market. So let's look for this convergence in this area right in here for critical levels of support. Now, another factor to consider, sentiment. Definitely starting to get into extreme fear, where we moved in the VIX from a complacent 15 level all the way up to 26 now. We're also above the rising 50-day moving average, which, as you know, we pointed out for since the beginning of May, how the moving average has been pointing up, and as an intermediate term sentiment indicator, definitely fear. There was negativity in the market, got a little bit rich, corrected somewhat during that bounce over the last week, and now back again to trading outside of the Bollinger Band, but also above the 200-day moving average. I would consider this an upgrade in the fear index and an additional notch into the longer-term trend turning. So sentiment definitely reaching, not quite panic levels, but definite fear is entered the market. So this indicator is on a sell signal. Now, let's take a look at bonds. You can see bonds have reached their lowest level in history. So that's got to tell you something. Now, like many people, I really thought that these critical levels up in here, this rising channel, would contain the market. We did get that sell-off as we got some pretty good news economically in the U.S., and that was quickly reversed. So, it really pays to be totally flexible. Let the markets tell you what's going on. Right now, it's looking like rates are headed even lower, and there's going to be continued pressure on the market. Are we a bit running rich? No question. But one thing you always have to take notice is when the market makes all-time highs on really good volume, there's no telling when a parabolic market may stop. So in this particular case, have to be friendly to this trend. It's indicating, lots of stress in the markets. Several things are playing out in the interest rate arena. Obviously, the J.P. Morgan bet is spilling over into the safety of U.S. Treasuries, the sovereign debt issue in Europe also an issue, and the slowing U.S. and Chinese economy is definitely making even these low rates attractive on multiple levels. So as the fear increases, as the market sells off, you have an additional pressure. So you got multiple factors adding up to probably even much lower rates than where we are. But let's stay flexible. If there's a topping or a short-term pattern that emerges, we'll be on top of that. But nonetheless, right now, all-time low in rates has got to give you pause where the equity markets are and what's going on around the world. And bonds are usually the best predictor of overall economic activity. So let's take a look at gold and see how gold responded. Well, gold closed the month of May under the long-term trend line, and you had a resounding strong close under that big trend line. Now, what we want to be cognizant of is the fact that on a shorter-term basis, the market reacted like a safe haven on Friday. At one point, gold was up almost over $60. So we want to keep track of this trend line here in the gold monthly charts. Right, we broke that monthly. If we start a return move to the top of this trend line and take it out, I would say all bets are off on continued weakness. Meanwhile, we have a nice counter trend rally going on within the longer term trend, within the shorter term trend selling off. So the other thing of interest, let's look at the weekly chart. Weekly chart, you can see we've had this trend line, or even a rising trend line right here, which basically held this sell-off. We also took out, I believe that's the, let's see here, let me change this chart to 65-week and a 200-week moving average. Okay, as you can see, that 65-week moving average, which contained it the last time, we breached it, touched it again on this rally this week off of the bad economic news and the market meltdown on Friday, and basically sold off as it approached that high of that 65-week moving average. So again, what we want to keep track of is sort of this wedge action in gold, and that's going to give you another indication. If we can break out from this wedge here, you can see we've got this right longer term trend line, bounced basically off of it. We had this from last year, and again, an important trend line here. If we can break out of this wedge, that would be a sign that economies are in deep trouble, and you can have a real large parabolic move above this 165 to 170 level. We want to watch that. That's pretty critical. You'll also have another early warning. If you want, you can put in this trend line right over here, and you can see we're bumping up against it as we talk. So if we can close above that 65-week moving average, that would be another footnote here that continued pressure. Gold is acting as a safe haven, and you want to be careful that you don't miss out on a potential move from the 160 level all the way up to the 165 to 167 level up in here. That's a pretty good size move. So again, this critical level here, the highs coinciding with that rising 65-week moving average. However, let's take a look quick at the daily chart before we move to the euro. Again, you can see that same trend line that we had on the weekly chart was drawn in here on the daily. And what we had was a couple of tests of this 149, 150 level in GLD, and nice snapback from those levels, along with almost a breakaway gap to the upside. Sold off a little bit on Friday from the highs, and a declining 50-day moving average. So we're at an interesting point. If we can start taking out these levels in here, that declining 50-day, we would have a phase change. And again, we want to keep track of these phase changes and how they occur. And taking a look at this, you can see that the strength on the up days in gold, you had an up day on this key reversal as opposed to the sell-offs on some of the down days. So you had a couple days with down price action, relatively light volume, and some really good action to the upside on some of the days that rejected that 149.50 to 150.50 level. Okay, let's go to the euro, and we'll then have that worldwide tour. And what I'm going to do is I'm going to focus on the weekly charts. And basically you can see here on the weekly charts, if you follow the cursor, I'm looking at a potential sort of head and shoulders pattern with a declining neckline. So lots of pressure. Are we short-term oversold on the weekly charts? Absolutely. You can see we attempted to break through this neckline here. The market basically closed within that that trend line. But longer term, I'm looking for a potential of the count of the on this particular head and shoulders top to come down to almost par. And how do I get there is, as you can see, the neckline comes in somewhere around 126, 127. The high of this move is about 147. You're talking about 20 to 25 points from the neckline to the top of the head of this pattern, this head here. So it gives us a longer term count almost down to the parity level. So let's watch how this handles another test of the neckline if we do get it. But if we do, you're definitely looking at continued weakness and lots of pressure due to all of these sovereign debt issues and all the stress on the system on the euro for this period of time. Taking a look at the daily chart, again, you have an interesting pattern here. You did make a new low and basically closed in the top part of the range. Potentially a short-term reversal pattern, not all that impressive yet until it confirms with some price action out of here. So maybe work off a little bit of the oversold that you saw on the weekly RSI as played out on the daily chart. Get a little bit of a bounce here, but longer term we're definitely looking like the euro is in trouble. And also look at the steepness of this declining 50-day moving average. All right, so that wraps up this week. Let's stay frosty. Markets are definitely fluid and moving. Going to be subject to lots of news. Don't forget, the powers that be are going to want to hold these markets up and keep things together. So you have the charts playing out on a basis that looks like there's lots of pressure here on the markets, and you got potential phase changes across the key indices, the U.S. equity indices. That's important. And on the other hand, you've got the powers that be that could counteract that. So we're going to have to stay fluid and flexible. So have a great week. Start enjoying the summer. And there's always opportunity in these markets. And gotta love the volatility. So this is Keith Schneider saying bye for now. And again, if you like this stuff, sign up www.marketgauge.com. Get this video newsletter for free every week, or you can just get the video over at YouTube. Thanks, and bye for now.